Good afternoon, ladies and gentlemen, and welcome to the AFERIAN PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand you over to Donald McGarver, CEO, and Mark Carl, CFO. Good afternoon to you both.
Good afternoon and welcome, and thank you for attending our 2021 results presentation. So first of all, I'd like to leave you, well, hopefully I'll leave you today with three key takeaways. First, and probably most importantly, is that we now have a full product portfolio and a company aligned with some good growth market opportunities. And in markets, the streaming market, powering the streaming market, where we see a fantastic opportunity for our company, for our solutions, and for our people. Secondly, we're going to talk about double-digit growth across key metrics. But most importantly, what that does is, gives us, coming into this year with a lot of momentum, really good revenue visibility and a much more improved quality of earnings. And that's not just from our recurring software, which we'll talk about, a key focus and for the business, but also a pipeline of software, and also even our devices, which we are seeing really good backlog. And despite these supply chain issues, that means that we're working closely with our customers to get better backlog and better visibility and longer term commitments to ensure that they can get the security of supply of their product. And thirdly, we'll talk about the new facility we've put in place, a $100 million facility, 50 million facility and a 50 million accordion that allows us the opportunity to execute fully on the pipeline of M&A opportunities we've got, which I'll go into a little bit later and explain in a bit more detail about where we're targeting use of those resources. So it's double digits across the key financial metrics. Revenue up 12% to $93 million, almost 25% of our business now from software and services. But most pleasingly, and a key focus for us, is that improved exit ARR. We saw 43% growth in that this year to 15.2 million, 23% coming organically and 20% coming through the acquisition we did at the half year of Nordia. And dividends are increasing. There'll be a 2.09 pence dividend issued in April, which represents a 10% year-over-year annualized dividend. So all good. Let me pass you on to Mark, who'll take you on a little bit more detail on some of the financial numbers and the financial metrics.
Thanks, Donald. Donald just talked you through the revenue, software and services, and the exit run rate annual recurring. Of the software and services revenue, you can now see that 58% of that is recurring. And as a reminder, when we bought 24i in May 2019, we saw that business had 45% recurring revenue, and that's now up to 58%. Our target internally is to get that 70% recurring revenue of our total software and services revenue, because that really is driving our business and driving our margins. And we'll talk you through the investment we're making in the products to drive that exit recurring run rate revenue a little bit later on in the presentation. Importantly, the revenue increase that Donald talked about has increased adjusted EBITDA to 18.4 million. And we continue to have strong operating cash flows, although we have seen a working capital outflow this year as we've been impacted by the timing in Q4 of some of our device sales. And I'll talk you through a bit more in detail on that on the next few slides. If we move on to the income statement, you can see quite clearly there the impact of the increase in revenue driving through into our EBITDA and operating profit number, now up to 11.8 million. Our margin we've maintained at 48%. We've seen increases in our software and services margin from 81 to 82%. And we have seen a slight decrease in our device margins from 38 to 37%. And that's despite the fact that we've managed to pass on most of the component cost increases to customers. You'll see a little bit later on that we've increased our device revenues by about 10% year on year, 5% of that coming from increased numbers of devices we've sold, and 5% coming from increases in prices. In terms of our exceptional items, these mainly relate to acquisition and integration costs, also include the aborted acquisition cost of the Mobi TV deal where we were unsuccessful in bidding for that company. That company was the M&A for that company, the premise of that was to expand our TV as a service offering in the States. And actually, importantly, we did manage to get in front of all the Mobi TV potential customers, about 110, to really expand our brand from the Amino that they know and love to also the 24i business in the States. So it was money well spent. In terms of share-based payments, that number has increased and we expect that to decline marginally this year. And our amortization of acquired intangibles has declined as previous acquisitions, intangibles related to previous acquisitions 5 years ago have rolled off. In terms of the tax number, the most interesting part of that tax number for us all is the current tax charge, which has increased from 1.9 million to 2.8 million. That's mainly as a result of the profitability of the Amino business, which holds its IP in the UK, where we've now run out of UK tax losses. Importantly, we do retain $15 million of tax losses in the Netherlands and in Finland related to 24i business, and we'll be using up those going forwards. Moving on to the next slide, we split out for the first time our core engineering expenses from R&D expenditure. In previous years, our R&D costs had comprised both customer support, professional services, and R&D expenditure, but we split out that specific piece in terms of the investment we're making in our products for the first time this year. So our total R&D cost this year was $13 million, of which we capitalized about $8 million, meaning that the net R&D cost in the P&L above the EBITDA line was about $5 million. The increase really here is due to the Nordia acquisition, the focus on the software-led projects, particularly in 24i, but also in the Amino division to drive recurring revenue. And we also have seen wage increases in the high single digits to make sure that we retain a skilled workforce in quite a competitive environment. Overall, our R&D expenditures as a percentage of revenue is about 14 to 15%, and we see that continuing this year and declining thereafter as the product becomes more mature. And Donald will talk you through the modular product in our businesses that's driving our recurring revenue in the operational section later. If we move on to the balance sheet, two interesting points to note here is one, that we maintain a net working capital negative balance, and that's because we invoice customers in advance in our software and services business, and in the devices business, we get better payment terms from our suppliers than we give our customers. The increase in trade receivables compared to last year is due to the timing of device sales. Now, although we have been ordering components well in advance, and Donald will talk a bit more about the supply chain management we do, we did see a lengthening of lead times in the year, which meant that we had less sales in Q3 than we expected, and more sales in Q4, certainly than the previous period. And that's why those trade receivables have increased, not due to an increase in debtor days. In terms of our new facility, in December, we secured a new bank facility for $50 million, which also has a $50 million accordion with it, and that's with Silicon Valley Bank, Barclays, and Bank of Ireland. It's a 3-year term with an option to extend by plus 1 year and another option to extend by another year. It's really put in place to help us drive our M&A agenda. We've seen in the past that we've lost out on M&A opportunities when we've come up competing against both private equity and corporates with cash on the balance sheet, and therefore fast access to capital is very important to us, albeit that we may then choose to refinance any amounts drawn under this facility going forwards. Moving on to the cash flow, you can see here quite clearly the impact on adjusted operating cash flow on the movement in working capital. Exceptional cash costs also include the last payment of the 24i deferred consideration, which went through the P&L. The eagle-eyed amongst you will notice that our corporation tax cash cost is higher than our amount in the P&L. And that's because in the UK, we moved into the large company bracket for payment of tax, and therefore have to make corporation payment tax in advance, whereas previously we were making them in arrears. You can see the capitalised development costs there quite clearly. We talked about earlier the cash paid for acquisitions relating to Nordia, and also the proceeds from issue of shares. And we did issue shares, as I mentioned earlier, to help finance that potential Mobi TV acquisition. So we retain those funds on our balance sheet with cash balance at the period end of 14.2 million, which is our gross and net cash balance.
So let me talk a little bit about the strategy and the operational review for the business. So first of all, I think really important to look at how we've actually changed over the last 5 years. And what you see with these little icons along the top, this is the end-to-end video platform that we deliver today. Now we call this Mod Studio. It's a series of modules or components that we can engage at any part upon this supply chain with customers, or offer them that whole end-to-end solution. If you go back to 2016, we were a company that offered streaming devices, managed streaming devices, and our customers were telecommunication companies or some enterprise video providers. Today, we're very different. We're an end-to-end video streaming platform, all the elements that go together to deliver high-quality video securely to end consumers. And we do that through all screens, not just the device in the home, but through your smart TV, mobile devices, Roku, whatever the customer requires, any device, anywhere, anytime. And our customer segments moved from not just traditional pay TV providers like telecommunication companies, but broadcasters, content owners, media providers, sports rights holders, and enterprise video providers. And we believe that we've got the opportunity to expand even further now that we've got a comprehensive end-to-end platform to deliver video. And streaming, the area that we're really focused on, we've always been focused on, is now mass market. Even baby boomers like me, COVID's taught us that streaming's where we want to access our content. We're spending more on our content. You can see some of the stats here that in the US, since 2020, people are spending 25% more per month. And then I thought that was a rather remarkable stat, saying that 13% had 7 or more streaming devices, until I realised, and I counted my own at home, and I have 7 of them in my home. So constantly trying to find ways to use that more effectively, to get all the content I want all in the right place, and we'll get that easily. And that's what we help our customers to do. And what we did was we took a look at our addressable market. We looked at the market for our streaming video platform that we deliver through our 24i brand, and also through our devices, streaming devices that we deliver through the Amino brand. And if you look at 24i, we're addressing, and we've taken out all of the kind of tier ones that we wouldn't be tackling, and people like Netflix and Disney Plus and Amazon Prime. If you look at just our core addressable market, we see good high single-digit growth numbers. But more importantly, within that, we see that our target customers no longer want to be managing data centers and put resources and effort into developing video. They want to come to someone like us and take that as a service. And therefore, we see double-digit growth in terms of recurring revenues there. Hence that focus on being sticky and adding value for our customers. And in the streaming devices side, as we've seen for the last 2 years, and we expect over the next 3 to 5 years, there continues to be a proliferation of streaming devices, people taking more of these devices into their homes and into their video ecosystem. So we see really good growth, annualized growth over the next few years, and our device is very much aligned to address that. And as I said, within the core segments, the core verticals that we tackle, we see each of those, having a real good demand for streaming services. Even pay TV providers who no longer really invest in as much in the linear television, all their investments going on to deliver their content over streaming services, and that's what we help them do. If you look at content owners, we announced the customer last year, the Canadian Hockey League. Of course, they have franchised that through broadcasters, but they've got a really good back catalogue, a whole set of additional content that they now want to deliver directly to consumers, and we do that for them. And if you look at some of the content owners, we talked about Cinesance, and effectively a Netflix of French language video, bringing all that content to the end consumer, and that's delivered by ourselves. And even traditional broadcasters, people that are customers, NPO, the Dutch national broadcaster, now offering more and more of their solutions via streaming and OTT, and that's what we do for them. And how do we do that? Well, we've packaged it into, we call in 24i, we call it our offerings Mod Studio, a set of modules or components that we can deliver an end-to-end streaming platform. And we package those up to go to market either with individual modules, but also with groups of modules, which we call video stage, backstage, and app stage. And most commonly, we go to customers with app stage, offering that user experience, the look and feel, and delivering that to a multitude of consumer streaming devices. We'll then potentially offer them the whole the back end platform we call video stage, and then we can knit that together with what is part of our secret sauce is what we call backstage, the ability to integrate all the elements, configure those, drive data, and improve and enhance that solution for the end customers. And then when you go to Amino, we deliver, again, 3 package sets of solutions. Amino Engage, a SaaS platform that helps to manage, resolve, and optimize the device. Our Amino operating system, which we deliver bundled as part of our device, but also on competitors or ODM devices for some of our customers like PCCW. And then, of course, our devices themselves that come bundled with that software solution. And actually, we're a little bit unique in that we've always been streaming pioneers. We've always been in streaming. If you go back to the formation of the company back in the mid-1990s, it was about delivering video over open broadband and managed broadband. And we've continued to do that. So in our DNA is that streaming experience. That's what we've always done. And we're uniquely positioned in that we don't just provide the software platform, but we provide that integrated with the devices and the ability to manage the devices as well. And our platform now has massive potential in that not only addressing some of the verticals we've got today, but some of the new verticals such as esports, education, etc., and being able to get access to the benefits of delivering against those. And just touching on some of the operational highlights, we did an acquisition of Nordia in May 2021, fully integrated now and helping us grow our TV as a service solution. And the focus in this division has been all about ARR and exit ARR. We've seen a significant increase, most of that coming organically, but also some help from the Nordia acquisition. And some new customer wins really helping us on that, what we call land and expand approach. You know, we're expanding through, once we land these customers like PureFlix or Cable Nord, not only are we growing through their growth and subscriber base, which we get a fee for, but also we see them taking up more and more of our Mod Studio, more of those modules and the ability to deliver that end-to-end solution. So PureFlix started as purely an application implementation, and now we're moving them through that supply chain for video and giving them more and more of our end-to-end solution. And Amino, obviously a very challenging environment with some of the supply chain challenges. And we were very fortunate in that back in 2009, we'd already began to see some of the impact of extending lead times, of costs increasing marginally. And at that time, Mark and I sat down with our supply chain team and started saying, well, the opportunity, if we don't have product and people don't realize lead times are going to go up, we don't want to miss out an opportunity. And so therefore we put in place a fairly significant commitment to additional chipsets and key components. Well, we got very lucky because obviously we didn't forecast COVID, but that meant that we actually had already on order enough inventory to satisfy the demand of our customers. Now, those increasing lead times, they went from 7 to 12 weeks, then jumped to 26 weeks, 40 weeks, and in one case, particular case of a core component, it still rests at about 55 to 60 weeks. So we did see, as Mark said, we saw a little bit of impact on our working capital as some of those get delayed into October and November. Had we been able to get even more silicon, we would have, the demand is there, would have seen bigger increases. But we saw an 11% increase in revenue, half of that coming from shipping more devices, and half of that coming from increasing on some of the costs, which is, as our input costs have gone up, we've had to pass as much of that on to customers as possible. Not always an easy discussion, but something customers now appreciate if they want security of supply, which is really important to our customers going forward. We've seen a big increase in our devices under management, our SaaS platform, Engage, and now over a million devices under management there. And we've had a few really good contract wins. One of the side effects of these longer lead times is that to obviously get the security of supply, we talk much closer to our customers, and they're giving us much longer commitments. And some of our customers now committed well into 2023 because they realise they want to make sure they've got these devices to get into their consumers' hands. And Mark, do you want to talk about the NRR?
Yeah, so what we've published for the first time this year is our retention rates and devices ordered from customers that have ordered in the last 3 years. And what we're aiming to show here is that our exit ARR growth is actually mainly as a result of existing customers growing their services, plus also from new customers taking our services this year. And what we tend to see is two things from existing customers. One is that our existing customers are growing, and there is a small element of our revenue that is linked to the number of users on each platform. And then there's also an element of our revenue where we're landing and expanding with customers. So customers are taking more of our platform, pushing their product out to more different types of screens, and that's also increased our revenue. So we've had an increase in our net revenue retention rate this year from those two factors to 117%, which is therefore increasing our recurring revenue organically. In terms of our devices are bundled with our software, and they typically have margins of on average around 37%, as I mentioned earlier. And that's really due to the fact that we bundle our devices with software that is integrated into our customers' video streaming ecosystems. And therefore, we get a lot of repeat orders from customers who are satisfied with that product and want a system that just works. And what we've seen typically is that over 90% of our orders come from customers that ordered in the last 3 years.
One of the things we mentioned when we're looking at our R&D expenses, there is out there a bit of a war on talent. And being a global company operating in an international environment, we're seeing this in almost every geography. So looking after our people, our key asset, is really important to us. And you may recall that we talked about last year when we hit COVID, what we said is we'd look after our people would look after the customers, and the customers would then take care of business. And that mantra continues as we go forward. With over 350 employees, we want to make sure we're fully engaged with them, we're developing them as necessary, and we're making sure we're giving them the right culture, a culture of innovation that they can thrive in. We started a graduate recruitment program last year. We'll continue that this year, and we will continue that going forward. It's given us a really good seam of talent that we're bringing in, that we're developing. And one of the things we talked about flexible working practices, we're not forcing people back into the office. It's interesting because what we've actually seen is we've seen the productivity in our business who went remote actually improve. However, we do need to get people together to get that problem solving, the innovation, the creativity again. So we're encouraging people to come back. We're making our offices and the office environment attractive enough that they want to come and spend some time. Instead of having off-sites, we're now moving to an on-site kind of environment and making sure that people worry about missing out by not being in and being with their colleagues at least from time to time. But a focus on the employees, making sure they've got the right environment and addressing that kind of war on talent, which we're managing to keep ahead of. Mark, maybe you can talk about our ESG.
Yeah, and ESG really is embedded into our company. It's more about people than anything else. Last year, we issued our first ESG report last summer, and we put a lot of effort into thinking about what we do around ESG and making sure that our employees were coming up with that themselves and brought into our process. So we set out our mission statement. Our mission statement is all around our responsibility to ensure a diverse workforce and a positive work environment for our employees, but also sourcing responsibly through our supply chain and reducing our impact on our planet whilst also engaging with our communities. And we use an overarching concept of being a reason for being, or the Japanese concept for ikigai, to do that. In terms of our immediate priorities, our teams are working closely in the Czech Republic, for example, with a Women in Technology initiative, and we devote both people and money to that initiative, which also helps us recruit to make our business in our development team in the Czech Republic more diverse. We've also been looking more closely at our supply chain than we've ever done. We have always ensured that our device manufacturer supply chain have signed up to our supplier code of conduct. And this last 12 months, we've been auditing the factories themselves. We've now audited 2/3 of those factories and aim to audit the final ones in this quarter. We're also looking at our carbon footprint, and we do that in a number of ways. One is our employees reducing their own carbon footprints in terms of amounts of travel they do. We've also obviously seen lower office costs and office footprint these past couple of years as a result of the pandemic, but also as we move forward into more flexible working practices. And then more importantly, we're looking at the supply chain and the use and recycle and upcycle of our devices. So we continue to upcycle our devices, making sure that they can take advantage of the latest and greatest user experience in the field. And we've done that at a number of customers now, including Cincinnati Bell, PCCW, and more recently, Vodafone in Iceland. We also do recycle many of our devices, and we'll take those devices from customers who are upgrading in maybe higher ARPU markets to more powerful devices, and we'll ship those into lower ARPU markets where they can make use of those and extend the life of those devices. And then finally, what's really important to us is that our employees also come up with their own ESG initiatives. And at the moment, the employees are focused on looking at the environmental carbon footprint of streaming itself and the amount of hardware and infrastructure used to deliver a video streaming service. And they're really passionate about working out how they can make that as efficient as possible for our customers so that they can reduce the amount of carbon which is used in video streaming itself.
So let me we talked about that facility we had, as Mark alluded to. We've seen a number of good opportunities over the past few years where unfortunately we lost out. And we lost out because that access to capital, the ability to move rapidly, to give some assurance to the targets, shareholders or investors, that we'd be able to get that done quickly when compared to private equity or some corporate that had some good financial footprint. And as I said, up above, we've got this mod studio, those icons there, and all those elements. And one thing we need to do is fill out a little bit more of that ecosystem or enhance that ecosystem. And we've targeted 3 key areas that we see an opportunity for M&A. First of all is the sort of emerging, some of these emerging technologies. And what I mean by that is things like data analytics, personalization and recommendation, and metadata and AI or machine learning. And then secondly, we're looking at how can we increase scale, thereby getting revenue synergies and potentially cost synergies, to grow our presence in the market. And finally, we talked about unable to complete the Mobi TV acquisition. We'd like to expand into some new markets and verticals, North America being one where we see an opportunity. And again, through our M&A strategy, we believe we can execute on that. Clearly, some of these are smaller bolt-ons that will enhance revenue, enhance the offerings. Some of those we'd like to be much larger to help us in our 2025 growth strategy. So really, in summary, we made the transformation. We're really focused on growing that recurring revenue, and we'll continue to grow at a good clip. We're continuing to invest in our products and driving more products that align with the needs of our streaming customers, but also help us to keep the roadmap ahead of today and tomorrow. And then, as I said, we've got that M&A strategy to further underpin the growth and a very targeted set of pipeline and opportunity. So any questions?
Mark, Donald, thank you very much. That's great. And thank you for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab that's just situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Donald, Mark, if I could please ask you just to open up that Q&A tab on the right-hand corner of your screen. As you can see, we've received a number of questions throughout today's presentation, and thank you again to all investors for submitting those. If I could please ask you to read out those questions and give a response where it's appropriate to do so, and I'll pick up from you at the end. Thank you.
So we've got one here from Andy M. It says, what inflationary pressures are you seeing, and can these be offset? I'll get Mark to comment as one along. Obviously, there's two things. One, on the device side of the business, we've seen, component increases come in. We saw that in semiconductors, for example, there's an average of 20 and sometimes more % increase. Clearly, that's not in the whole product, but we have had to pass that on to customers. And as I said, it's not an easy discussion to be having. The customers understand the pressure we're on, and we've done that in a relatively transparent way, so as that they understand that, if things change, we can reverse that. But they understand that that's what's necessary to secure supply. So I think we've been relatively successful, and we continue to manage that with our customers. And the other thing is, obviously, we are seeing wage inflation, and not just, in one area. We're seeing that across the globe. We're seeing that in some cases in high single digits, and we're having to, address that as best we can. And unfortunately, it does mean we have to pass some of those costs on to our customers as well. Mark, any other comments on that?
No, I think that's a good summary, Donald. One question from Simon C about the dividend policy. Yes, he's asked what the dividend policy is. Is it the same to pay between a third and a half of adjusted EPS? And I can confirm that is our current dividend policy, and that's what we based our dividend off this year, whilst also increasing on an annualized basis by 10%.
We've got a question there from Michael D. Can you talk about the competitive landscape, where you're positioned, who are you competing against, and what areas are you targeting scale M&A? So I'll come back to the M&A. I've probably covered that, but competitive landscape, I mean, we're pretty unique in that we actually offer not only an end-to-end platform, but we combine that with a set of managed devices. So for some of our customers like Ufone or Delta, we can provide them with that whole platform in the home and out with the home. So TV everywhere type solution. There are really three areas that we individually compete. There are platforms, there are applications, and there are devices. In devices, there's a number of large players, but we are now really competing in that streaming device area, and you'll see that some of the growth has come through our Android-based devices, the fact that we are nimble, the fact that we have this software that allows you to manage the device and give the right quality of service kind of differentiates us there. In applications, we compete against people like Axido, Delta Tray, amongst others. But actually, how do we compete against them? Well, we bundle in. It could be our platform. On the platform side, we compete against companies such as Kaltura or Minerva or MediaKind, who are also in the marketplace. So a number of competitors in different areas, but we try and differentiate by bundling those together and by offering that end-to-end platform combined with the devices as well. In terms of M&A, as I said, three areas: emerging technologies. We talked about data analytics, personalization, recommendation, metadata, and machine learning and AI are the key technology areas. Then we're looking at scale, where we're looking for revenue synergies and also cost synergies, and maybe a little bit larger in that area. And then we're also looking at trying to get into some of these key markets, geographic markets, or key verticals that we are interested in.
I think on the question from Simon C, another one that we can see. Can you expand a little on your roadmap? What should we specifically look for in 2022? I think I could summarise that quite quickly by saying that if you looked at our recurring revenue growth that we showed earlier and our net retention rate of 117%, all our investment, or majority, all of our investment, is going in to increasing the productization of our platforms such that they are configurable rather than customizable. So you can, in terms of what you can expect in 2022, you can expect to see that recurring revenue growth continue as a result of that.
Mark, Donald, thank you very much for addressing all those questions submitted by investors today. And of course, ladies and gentlemen, the company will review any further questions submitted today and will publish those responses on the Investor Meet Company platform. Donald, Mark, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to the company, could I please ask you for a few closing comments to wrap up with?
Yeah, I mean, I'll go back to the start. I think there's 3 takeaways from today. One is that we're aligned with a growing market opportunity. The streaming market is very much a growth market, whether you're a traditional TV operator or one of the new media companies, and that's where we're providing core products and solutions to address that. So we've got a really good tailwind behind us. And you know, the kind of metrics we've shown you today, the double-digit growth across these key financial metrics is all good, but more importantly, it's given us that improved quality of earnings and that improved revenue visibility. And finally, with the facility we've got in place, a targeted set of opportunities within an M&A pipeline, we feel confident we can go and execute well against our 2025 strategy. So 2021 a great year, but more importantly, lots of momentum and lots of capability now behind us to go and execute on our 2025 strategy. So thank you everybody for your time.
Thank you.
Mark, Donald, thank you very much for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of AFERIAN plc, we would like to thank you for attending today's presentation, and good afternoon to you all.